I mean, obviously this came as a big surprise to the market. Why didn't we realize how bad it was going to be?
Yeah, we were expecting significant deposit outflow. This is worse than expected. I think it just shows the nature of the First Republic model, where they had very high average deposit sizes, and that's where we really saw the pressure in March, was at the banks that had very concentrated deposits, and that's where we saw the outflow. So yeah, definitely more than we expected. We were expecting a high number. This was even higher, but I think again, it just shows the nature of the deposit base that was at the bank.
Ben, what are the options now? I mean, the company basically has to rapidly shrink its balance sheet, reportedly eyeing up to $100 billion in asset sales. It says they're looking for loans that they can basically sell quickly, the kinds of loans that they would even make at all at this point. Their wealth management franchise is in the middle of some turmoil. What do you think the next couple of days will now bring? I mean, it's odd how we've gone from exuberance yesterday into the print to now questioning again existentially whether they can make it. And again, their share price decline has gotten worse throughout the session today.
Sure. So I think they have four paths out of this. One, they can pray for a Fed pivot. I don't think that's going to happen soon enough. Two, they can strategically and surgically shrink the balance sheet. And so if you look at where their deposits are, they have a loan-to-deposit ratio of, I think, 165%. That's unheard of. So they need to shrink the bank, and they need to shrink it quickly. Probably $70 to $80 billion of assets they would have to sell. Number three, an equity infusion. So they could recapitalize the balance sheet. That would be dilutive to common shareholders, but that would be an option as a way to survive. And then number four, which I think is probably the most probable outcome, they need to find a partner to merge with and partner up with a healthier bank.
Ben, you had been looking at regional banks, buying up some of them in the turmoil. And I just want to point out this kind of micro cap, but it's a regional bank around here, Blue Foundry, is doing a share repurchase today, and its shares are up 6.5%. So where do you see opportunity in as chaotic and difficult a landscape as this is right now?
It's been a very challenging start to the year. If you look at the too big to fail banks, they're about flat on the year. And so I don't know that there's a lot of opportunity there. Where we've been focused on and what we've been investing in are what I call they're maybe too big to fail. That's part of the problem, is we don't know if they're too big to fail or not. And those are down anywhere from 20 to 30 to 40%. I'd put Regions, Zion, Key Bank, Fifth Third, U.S. Bank, Citizens in that bucket, where they're down 30% on the year. They're now trading at 6.5 times earnings, paying dividend yields of almost 6%. And that's not normal for a bank to trade at 6.5 times earnings. On average, they trade at what's called 12 times earnings.
Right.
So the market is basically saying those earnings estimates are 40% plus too high. And our view is that's overly bearish. And so we see opportunities in that next rung down in the big regional banks.
Although, Jared, I wonder at this point, no matter what happens in the near term, if we're talking about a situation where those banks are less profitable in the longer run, I mean, maybe there's more regulation. Again, they already face quite a bit of it. It's more the lower cap banks that would be hit by this. But do you agree with what Ben said about this tier being a place to focus for actually some opportunities if people want to dip their toes in?
Yeah, I mean, my coverage is a little bit below the level of those banks in terms of asset size. But yeah, what we've definitely seen through earnings is that there was not a broad-based contagion, as some people I think feared maybe in mid-March. So when you look at banks in the Southeast, when you look at banks in strong geographies that are still the trusted financial advisor of their commercial middle market customers, we still think there's a lot of opportunity there. In terms of expenses, yeah, there's likely to be higher expenses. Certainly from FDIC premium surcharges. And then on capital, we're likely to see some change in the way these banks have to calculate and allocate capital, which will put incremental pressure on profitability. But to the point of where they're trading on a PE basis, we think there's still some really good opportunities out there in the cap banks.
And Ben, for people who are just so bearish, they say, I don't want anything, I don't want to have anything to do with this. You make an interesting point about 2008 and how the preferreds did back then. I mean, what would you say there about whether it's the bigs, the maybe too big to fail, some of the smaller players, and that being an interesting place for people to sniff around?
I think there's two opportunities. If you want to buy the common equity, I think these bigger regional banks are the way to do it. If you want to go further out on the risk spectrum and get involved in some of these banks that are more in the eye of the storm, so the PacWest, the Western Alliance, the preferred stocks are probably the way to do it. I think there's two ways to win. One, the bank manages through the storm and navigates through it. Or two, like I mentioned with First Republic, they partner up with a bigger bank and become part of a bigger, better bank. And when that happened in 2008, the preferred stock that was outstanding was converted to an obligation of the acquiring bank. And so Merrill Lynch, for example, became a B of A preferred stock. National City Bank here in Cleveland became a preferred stock of PNC Bank. And I think that could be a blueprint for an attractive opportunity for someone who wants to get into the banks that are in the eye of the storm.
Yeah, if they want to do that. I get, I'm queasy just talking about it. Thank you both very much for your time today. Really appreciate it. Ben Makovac and Jared Shaw.